Okay, there's been a delay when I start the recording to when the screen actually comes up, so I'm trying to kill about 15 seconds and then we're going to get ready to go. Hope everybody's enjoying the wonderful volatility of this crazy market. So welcome to the How to Make Money Trading Stocks Friday webinar. Both Mike and Michael are away. Mike's vacation in Southern California. Michael is in Malta, I believe, looking for some sunshine. Want to remind everybody that all the materials that we do present are for training purposes only, and that traders should always paper trade prior to the risk of their own personal capital. If Michael were with us, his would be his disclaimer. So we've entered the active trend trading. I am very much about training. I am very much about providing traders with an overview that can be workable in every market. Hey, Anil, how you doing? Got a really nice email from one of our members this past week, and he just really credits to the education he's been getting over the past couple of years to be able to stand outside this current market and not be compelled to take action because he doesn't have to. And so when I get emails like that, I know that we're succeeding in what we're doing from a training perspective. This next week we're going to be doing a review of strategy 3. I'm just going to call this supercharged covered calls. It's our wealth and income generating strategy. We've got 20% of our trading capital allotted to this strategy, and it's what's been keeping us afloat during this crazy market. So this week, what do we have going on? We found previous lows and held, at least held so far. We'll see if that continues to work out through the range of the day. And we seem to be marking time for either a bounce or a plunge further. As you can see, yes, we got a little bit of bounce off of various support levels within the, especially on the S&P, a little bit on the NASDAQ. Russell actually dropped to lower lows. And so the indices seem to be marking time, as I said, to either push further down or perhaps a relief rally is in the work. Right now, the charts are just basically yes, they are oversold, yes, they are getting further extended, and one would think we would have a reversion to the mean sometime in the near future. Outside influences, basically the same as they have been for the last several weeks. Earnings, oil, U.S. economy, global economy. The Fed is getting lots of flack from Congress and the Senate regarding their posture of raising rates moving forward, and they're questioning their evaluation of the existing economy. We've talked many times in the past, and so unfortunately Mike Traeger isn't with us because I really like to get Mike spun up on what he thinks about the Fed, which he doesn't hold them in too high regard. But we are extended, and we're ready for a reversion back to the mean. Will that be the 8-day moving average? Will that be the 20-day moving average? Will that be the 50-day moving average? At this time, we don't know. The clues are not in place yet. Read a very interesting little piece, actually I think last night, and the writer was saying that basically the whole market hinges on what Facebook and Amazon do. Now that's a lot of weight, but then that's also a little bit scary from the aspect of, 2 stocks out of thousands and thousands and thousands of stocks, and this guy's making his determination that that's what's going to dictate where the market's going. In the current market conditions, we are also seeing, and I'm trying to implement this within the active trend trading system for everybody, and it's not my preferred mechanism, but if it is a method by which we can be profitable and stay profitable, and we're going to just be implementing a kind of a hit and run trading, and that's the kind of environment we're in right now. And so as we look at the individual indexes and see where those are going. We're getting giant daily moves, and we just have to get ourselves positioned to take advantage of those. We've been doing a great job with strategy 3 doing that, and we'll continue to press and push forward with that. But we'll also be adopting some strategy 2 option trades, and perhaps some real short term, and I'm not talking about day trading, but I'm talking about just real quick swings where we're taking 5 to 10% out if we're trading the index leverage in ETFs. But we are a hit and run type environment, and we need to be taking advantage of that. So last week, the percentage of stocks above their 20-day moving average had popped up into the 55 zone and right into a level of resistance. We'll look at that on this chart. This is the chart as of about 9 o'clock this morning. It hit up into the resistance area and rolled over. And what are we getting right now? We started to rally back up out of the 30 area, and then it's fallen back down. Fell down to about 20 yesterday, bounced up today. Will that bounce stay in effect? Right now, we don't know, but a couple of positives that we can take a look at is, one, the market, the index has made a new low or came down and touched their previous low. If I have to cut away for just a second, I've got a trade going on Amazon right now that I want to get out of. And I've got my profit targets in on the order, but hopefully we'll be hearing some bells here shortly. Anyway, we come down here. This index, the percentage of stocks above their 20-day moving average, along with some of the other ones, actually provided a little bit of a positive divergence in that it didn't push down into the 5 or 10 level where it did last time it came down to the lows back in around January 21st. So that's a positive. Tries to make a breakout today. Right now the breakout is, it's looking suspect. Like the market is saying, yeah, the buyers came in. However, the bears have overpowered the buyers at this particular point. Somebody had been asking for, can you do a comparison chart? When you look at this longer term, this is a percentage of stocks in the NYSE above their 200-day moving average as of about 9 o'clock this morning, and it's sitting at about 15.48. That is this black line here. The chart that I'm charting it against is IWM. In other words, the index ETF for the Russell. And as you can see, and they're both charted against the right-hand right-hand scale, and typically we're looking for pullbacks down below the 30 level, and of course we are clearly in that. It's looking like this current pullback may come back. We may get a little bit of a bounce up, that's due, but we may get some stagnation down here about the 10 or lower level, which was exactly what happened at the end of 2008, just before the market went back into its big upswing. However, remember that from the about March timeframe in 2008, the market took off on a dive that went down about 35+%. The other thing you can see here, excuse me, is one of the reasons why Mike and I really like this chart is that while the percentage of stocks above their 200-day moving average was putting in its top, it actually topped earlier than the IWM. And this period of time went on here before we finally had a failure for about 2 years. So during the year of 2013, we were starting to get the signs of deterioration within the individual indexes. And finally, the number of stocks above their 200-day moving average started failing in the NYSE, and eventually the weight and the inertia of those failing stocks impacted the IWM, and when the Feds raised the rates right here, IWM said, you know, I just give up, I'm out of here, and it's going on its dive right now. So I just wanted to share this with everybody to see what, you know, what we were seeing and what we were looking at and going, aha, here's what, and again, the red and the green line are not associated with this green price line, that is the IWM, only with the black line, which is the percentage of stocks above the 200-day moving average. But anyway, very interesting how this basically telegraphed what was going on in the NYSE, telegraphed what eventually played out on the IWM and also the other indexes. Okay. As of about 9 o'clock this morning, and things have changed a little bit since then, have actually dropped down from these levels. But one of the things that I did add in, and I will be continuing to track this, the S&P, the NASDAQ 100, and the Russell are the three tracking indexes that we use with the active trend trading system. The reason why is each one of those has an associated index ETF, and the leveraged index ETFs and the inverse ETFs. However, it's a good idea to keep our eyeball on also the NASDAQ composite, which is made up of over about 3,000 stocks. It varies because as you can see, it's actually been weaker than the NASDAQ. From its high, it's down 16.57. And both of these indices here have come really close. The NASDAQ composite this week at the low reached about 18.5%. So that's only 1.5% away from being in bear territory. And again, the Russell itself is in bear territory, has been all year. And many of the stocks on the indexes are also they're off over 20%. So that's kind of an interesting perspective that the internals and that's where Mike and I were talking about the internals. The internals are exceptionally weak. Claudio, know that that $MMTH is only available at this website here, barchart.com. And if you want the specific link to that, to what we're looking at here, just shoot me an email and I'll send out that link to you. So let's look at the charts. This was last Friday with the big sell-off, and this week on the S&P, we have basically just hammered around in this support level between 1875 down here to 1812. And so here's a level of support and resistance. The price action is ping-ponging between the two. It came up really close to hit the 8-day, actually on Wednesday, and rolled back over. That would have been pulled back down. And as you can see, while yes, we have a rally attempt that's in place from yesterday, the rally attempt is not, at this point, not going very far. If we finish, okay, I'll be watching the finish on the S&P. If it finishes above halfway, let's say the 1850 level, if it finishes above 1850 today, that could be positive on a weekly standpoint, indicating that perhaps in the near term we may get a rebound in the S&P. However, if we finish below the 1850 in the lower half of this the wick on this hammer right now, that will tell us that will be a negative, because it will, this will not be a hammer anymore, and it'll be telling us that, you know, the sellers came in, overpowered the buyers, and are trying to push this market down further. As I highlighted in after our market updates, we've got support down here. Let me draw the other line. We've got support basically at every 50 points, all the way down to, this is the high from, I want to say 2011. No, I'm sorry. This is the high from 2007 on the S&P. And as you can see, there's little bounces all the way down on this weekly chart. And so for each one of those, that's where we would be anticipating, at least perhaps some bounces. Another thing I want to just highlight to folks is, let's take a look at the fib retracement from the low here to the high here. And this will be an approximation. There we go. If prices do push down and break through and does a round trip and breaks below the 100% retracement level, then it gives us a target down here at 138.2% retracement. And look where it's at, right in this support zone at the 1750 level, which corresponds to existing support over on this side over here. Oh, what's diving? Okay, the S&P's dropping off a little bit. And then it could basically try to base right here between 138 and 161 retracement. And if it breaks those level, then watch for it to stair step down. Stair step down, and it could stair step down all the way to this point. What type of percent move would that be if we fell from here? Well, one, it would clearly put us into a bear market on the S&P, and this is about a 14.7% downside move. Now we've already moved, and we highlighted this earlier, from the high of the year. We're sitting about, okay. There we go. Hope this didn't freeze up on me. There we go. We're sitting about 13.27. So a total retracement down to this low would give us put the S&P down about 26, 27 percentage points. This is really shaping up nicely. Nice rounded top, and it's looking, like I said, like the path of least resistance is not in the up direction. So that's the S&P. Take a quick look at the NASDAQ. NASDAQ also, as you can see, it's working in this this support zone. It's come up and come close to the 8-day moving average. And it's not just busting right through it, because for one thing, of course, we're in a downtrend on each one of the indexes. So get rid of that. So here's the trend right there. Lower low, lower high, and we may get a rebound back up into the trend line, and then a rollover, which will coincide probably about the time the 8 and the 20-day moving average drop down low enough. Again, over here on the weekly, well, we've got this strong support here at 3,800, and it's trying to hold up at 3,800. If we drop 3,800, then we've got 3,700, a support zone between 3,700 down here all the way to 3,400, where prices could base. But it looks like we've got one leg down, partial up, and we're in the process of our second leg down. And if you're a Elliott wave kind of person, that typically runs down in 3 legs, and that's what we would be looking at. And oftentimes this last leg can be the most severe. Take a look at the charts from 2007, 2008. Compare them to what's going on right now. I think you'll find it very interesting. Take a look at the Russell. Excuse me. Okay, Russell is basically every time it pushes up into the 8 to 20 area, drops. And so we've had basically one drop down, second drop down. I don't know if we want to count that as a push-up. I don't know, qualify. So it's depending on how you count it. We've had one leg down, two legs down. This may be the third leg down. How far might we go? Well, here's a target that goes back to, this one I think goes back to, yeah, 2011. The highs in 2011. And again, there's also some highs in 2007 to be aware of. And that's what we're basically watching. At this point, we have fallen, found some support at the 950 level. Would not be surprised to see a little bit of a bounce back up and then a rollover to move lower. Let's take a look at just real quick the weekly chart on this puppy. And I'll give you a better picture of what's going on. Excuse me. As you can see, the 2007 highs were just about the same height as the 2011 highs. And so we know that that is a very strong level of support. So we'll see where it goes from there. Now, before I move on, I've got to check and see what's going on here. This is where you gauge and go, well, do I let it continue to go or do you modify the order and to be able to take the profits off? And you know, I'm going to leave my order in place because I think that Amazon is going to get really close to $500 today. So path of least resistance, again, the timing may be such that we are looking at a potential time for a relief rally or at least an attempted rally. But overall, for the time being, the longer term trend is down, therefore the path of least resistance is down. It's very interesting as you are watching watching the stocks that that are on your watch list. Have you been noticing how when they push up towards the moving averages, all of a sudden, bam, they hit resistance and sell off? That partly may be due to the institutional traders who are committed to lightening their load, lightening their long positions. They're not necessarily selling out everything, but they have stipulated and they have stated, very plainly that they're going to use every little rally attempt to actually lighten their existing positions. So kind of an interesting perspective, and that's exactly what's happening. And I'm going to show a couple of charts as we get into the individual stocks that is showing that workout, exactly as the as it should be. So here's where we're sitting portfolio year to date. This is booked profits. And again, we've got 2 more weeks left to go in February. And so we've got a little bit going on strategy number 3, strategy 2. Strategy 3 has been our stalwart strategy. Here's what we've been doing. And when the market's down as much as it's down, I feel really good that strategy 3 on the $20,000 that is allocated out of the trading account for strategy 3, it's up over 26%. Strategy 2 is only up about 1.65. Strategy 1, which is the portfolio building portion of the active trend trading system, it's down 0.58%. I got into a couple of trades early in the year. These two down here, Huntington Ingalls and Tesaro, a little bit of a loss. But what we've seen here, this Spider and Tesla trade, where all the profits are, that is the result of basically increase in value on the underlying long leaps, and also selling and hitting our targets for the weekly premium that we're trying to take in from weekly trades. So with the market down 13-14% on the S&P, to be up cumulative on the whole $100,000, 5.5%, 6 weeks into the year, I'm good with that. So future presentations, monthly. If you're in the local Bay Area and you can come down to San Jose Masonic Temple, and we do our monthly BAM meetings the first Saturday of every month. I have completed my back testing of the active trend trading and early warning alerts for downside trades, and I'll have the report out this weekend. I'm in the process of updating training videos. Well, what does that mean? I'm basically going into the training videos for the 5 pillars of active trend trading. I am recording just the training position, so you don't have to sit there and mess around and listen to the first part of the midweek market sanity check to get a nice clean training video in place for everybody to take a look at. So if you do have a group, I would love to present at your group either in person or via webinar. So if you're an IBD person, I do have several presentations that are IBD okay, and so I'd love to have the opportunity to present. And like I said, I can tap in either in person if you're in the Bay Area or via webinar. And then if we type in, regardless, you'll get the webinar recording of the training session. So active trend trading system is based on our model of clarify, simplify, multiply. We rely on these 5 pillars succinctly: what to trade, top quality IBD growth stocks and or index ETFs, when to enter, entry action points, when to exit, what strategies to use, and what to expect. We initially designed the active trend trading system. Mike Traeger and I basically went back and did the back testing on it to make sure that it works. And what we also discovered is that all the strategies that we do use, the 3 strategies, they're all basically based on the underlying active trend trading system. So if you're watching this training or watching this webinar as a recording, or even if you are just online and would like to become a member of the active trend trading system and or the early warning alerts, you can get a discounted rate, $32.99 for the monthly. That is for the active trend trading membership. And if you want to do the early warning alerts, it's you get a savings of over 60% on that. You can find more information at this website here. So I think that covers it. Remember, okay, Claudia, yeah, that'd be great. It's not too far to, where's Folsom at? Folsom's up by Folsom Prison? Duh. Okay, I don't know how far it is from the Pleasanton area, but if it's a couple of hours, and commutable or can be done on a via webinar, that would work well. And so remember, Monday is the markets are not open on Monday for President's Day. And so see you guys next week, and keep the egg growing, trade wisely, trade profitably, and appreciate everybody showing up for today. So with that, I'm ready to look at some stocks. So, I was going to show a couple of stocks that kind of show this picture of what I'm talking about. One of them is Tesla. And in this market environment also, I'm kind of not throwing out my watch list, but I'm honing in on a couple of stocks and a couple of index ETFs, all the index ETFs, the SPYs, the Qs and IWM and their inverses and their leveraged entities is something I want to be and that I'm interested in potentially trading. I like those because, one, all I have to do is worry about the technicals primarily on them, but also I want to mix in a couple of stocks, and Tesla is one of those kind of stocks. It has significant daily ranges. Like, you can look at today's daily range on Tesla, it's 13 bucks. So that's almost 10% for a, stock that's, $147 stock. And here's what I'm talking about with the with these daily push-ups. As you can see, after earnings, on Wednesday, Thursday, it pops, came back up, touches and hits comes close to the 8-day moving average, and as soon as it does that, you can look at that on the intraday charts, and it almost immediately starts selling off. And that is, a lot of that is the institutions that are backing out of this trade. They don't want, they're kind of skeptical about what Elon Musk is selling these days, and so they started exiting, moving back out. Now, yes, there is a nice level of support down here at 140 and a level of resistance up here at 160 for right now. So this gives us a $20 range in which to look at potential trades for Tesla, and basically trade those trades. And the other thing is, Tesla is one of the stocks that we utilize for strategy number 3, and so efficiency and of effort allows me to look at this and look at it for both individual trades, either with options or buying the entity for a day or two move, and on the flip side of that, still be able to do the wealth and income based on the leaps that I have. Another one that is let's take a look at Amazon and yell at it because it needs to get down here to, how far did I get? Got down to 501. Yeah, my target is 525. We'll see if it hits there. But again, look at Tesla today, or at Amazon. Now, has a nice little bounce up, comes up, hits old resistance and the 8-day moving average, and then almost immediately starts selling off again. Now, is it going to sell on off down here to the 480 level? We'll see. At this point, we don't know. Same thing on Facebook. Okay, Facebook had what is called a failed breakout, regardless of whether you take that as a break above the 107 level after after earnings, or the 110 level, which is its previous high over here. Broke out, made a nice little run. Matter of fact, I was seeing this buying volume come into Facebook. I was going, okay, this is really good. I'm looking for a pullback down to the 110 or the 107 level. But as you can see, it pulled back to the 110, but the true indicator had just rolled over to head down. And then the next day, which this was Friday of last week, it started selling off, broke through the 107, 108 level, and I said, okay, I'm stepping away from this puppy. I am not going to trade this until it does some something constructive. And you can see we got a further drop, and now the individual moving averages are starting to roll over. We're starting to get on the weekly chart from last week. We have what's called a dark cloud bearish reversal signal on the weekly chart. And so to me, I'm looking at Facebook almost rather than a long trade as a potential short trade. But I just wanted to share that with you on those two. And then lastly, and then I'll be ready to look at some of your stock. Ellie. We had been following Ellie through all this junk over here, made this run up here, got up to this previous high around the 75 level, and then all of a sudden it dropped like a rock prior to earnings, which typically that is not a good sign for a stock. But then it reverses after earnings and actually pops significantly. However, what's the problem with this pop? Can't get past old resistance, and then it hit their old resistance and is starting to sell off. And so Ellie may very well be in a trading range from about 60 up to 75, but that's not a bad trading range. I mean, that trading range, from 60 up to 75 gives you about that's almost 25%. So we'll be watching Ellie to see what she's going to do. And she is very violent. She is very volatile. But hitting up there, hitting the resistance after earnings and then selling off. And if it gets down here below 70, below the midsection of this range, that's telling us that this is kind of a fake, more or less a fake out, or the buyers just aren't there to support what's going on. So GDX, gold miners. Gold miners have been doing pretty good. They here of late, they've got a nice little rally going. And let's see, is GDX, that's the gold miners ETF. Yeah, okay. So gold miners ETF makes kind of sense that they are rallying. As you can see, Jonathan, on a weekly chart, it's back up to the moving average envelope, and so it may push higher. And so what I would be looking for is for a potential pullback to retest this $17 level to see if it's going to continue. Everything is overextended from the moving averages, which oftentimes means they will do a reversion to the mean at some point. Looking pretty, like I said, it looks good. However, we are extended. Another one that somebody mentioned, which is also, I think, an index, GLD, gold. Or is it GLD? Okay, this is just straight. Now this is an ADR, so it may have some different tax issues and all that kind of stuff, but they do pay a really nice kind of, nice little premium or a dividend. It also is in the process of breaking out. You can tell from this line, I've been watching this for a while, but it got a nice little run. I mean, the run from here over the last several weeks, that's one heck of a run. And so if the economies continue to soften, if the world the world issues continue to fester and all that kind of stuff, gold may be a great place to park and take advantage of some of the opportunities. So any other stocks, guys? AHS. Okay, going into earnings, Eric. Earnings on the 18th, which is next Thursday. Let's take a look at it. We're at basically kind of at the bottom of a trading range. It may get a big pop back up to, these moving average on a weekly basis. But remember, earnings are an issue. Again, similar type thing. Hit the 8-day, fell. It did recoup itself fairly quickly, but until for me, I wouldn't even look at this for a pre-earnings run. ATO. What kind of energy, Anil? What is Atmos? Neil, are you there? Okay. Its volume is okay. It has broken out to a new high. On a weekly chart, it's kind of putting in what you'd call those 3-week type patterns. If you put in one more week after this one for a potential move higher, it is extended away from its moving averages. So I would expect either a reversion to the mean and or for the mean to catch up with where the price action is. Got a little bit of a support at 65.52. And you kind of use that as a gauge for if you get a pullback. When I'd be looking, anytime I'm looking at a stock like this, I'm looking for a pullback to support and then a rebound. I mean, that is just my trigger. Some people will do the breakouts, but I want a pullback to support and the trigger. A gas distributor, okay. And that's why they pay a pretty good dividend. I mean, 0.42. So that would be about $1.60 over a little bit over $1.60 on a yearly basis, which on a $70 stock, you'll have to do the math on what percentage that is. RHT. Red Hat. And each one of those ATRs or those, I would want to run the stock checkup on them. Sometimes the stock checkup doesn't work real well on some of the ATRs, but other times you can still get pretty good information. Red Hat, what are we looking at? Earnings coming up on 323, so we're a long way from earnings. It's in a downtrend. So if you're looking to short it, you've been a good short today at 64.27 off the 8-day moving average, or if it gets back above the 8-day and closes above it, then look for it to start to do some consolidation, constructive moves between 60 and 65 before moving higher. One could also look at this as being a potential shakeout plus. Draw a little line across here so that if the price gets back up above this previous swing low, and I think it's shakeout plus 3 or plus 2, it's about 10%. Anyway, if it moves back above this line, then that would be considered a shakeout. And if it was on strong volume, that would be a positive thing. But that tells us that what that does for us, let me do a little bit of explanation. It doesn't put the individual stock back into a full-fledged short-term uptrend. But what it does is, by closing back above this swing low, it at least provides one of the initial ingredients to go back into an up into an uptrend. And then typically, if we break out above that, what we would anticipate would be break above. Let's say it gets up to 70 because looks like there's resistance in the 70. Then a pullback to, and then a rebound from there. This is sorry about that. That's when we would know, after we did this little number right here, that's when we know that, the short-term trend is now up. So, okay, any more stocks, guys? Cisco. Now, Hawk was on a good list here not too long ago. Yeah, Hawk is looking, and here's what I'm looking at. I'm looking here on the daily chart. Volume's kind of fallen off on the daily chart. Volume's fallen off here on the weekly chart, and volume's fallen off on the daily chart. And it appears from the weekly chart, see these long-legged hammer spinning top, where buyers are starting to try to come in, but at every time they do come in, they are getting driven lower, which is an okay thing, but it's not great. We prefer to see it break, but it's telling us that it's trying and it's looking for a bottom. Will that bottom be between the $36 and the $33 range? It would make sense because 33 was a very strong level previously, and then I also had marked this. I was probably wouldn't drop down here, but this 36 level is also, so 36 is resistance, 33 is support, and at this time, still in a downtrend. Earnings coming up on the 25th, which is 2 weeks from now. I wouldn't jump, I definitely wouldn't jump right in, but this part is positive. Some of the things that is negative is on a weekly chart, we have no positive divergence here. We have no positive divergence here, even though we are at extremes where you would anticipate. On a daily chart, yeah, we're getting a little bit of positive divergence going there, but it's right up at the zero line on the momentum. Trying to get up to the zero line on the true strength indicator, which is typically the line of demarcation, the make or break line. Cisco. And I would want to run the stock checkup on this just to see exactly what it is currently doing. Okay, Cisco. I like the initial breakout, Barbara. Good buying volume. We'll look at this long term over a 2-year basis. It's basically been in a trading range from about let's say 29.50 down here to $23, $22, but is still a very nice buying range. This is definitely a reaction from earnings, and so I'd run the stock checkup on it, see what kind of fundamentals it had, and then make decisions from there on whether or not I want to keep this on my watch list for potential move. Another way people, traders can also work with range-bound markets is you find a little stock like this that's running between, let's say, 23 up to 29. Well, that is I didn't want that. I wanted something else. Hold on a second. That is about, let's just get that's about a 25% run. But on those range-bound ones, it's basically you have to design it where you get in. If the range is, say, in this case, 25%, if you can get 15% of the middle of that range, that's great because you know exactly where your stop loss has to be on both sides. So, okay. Let me see if I have a couple of stocks that I'm also looking at besides Tesla and the index ETFs. XRS has been holding up fairly well. And it got through earnings. It failed this breakout, but now fell back down into support and has held up pretty well, considering the market has not held up quite as well. So XRS looks kind of interesting. Would like to see it either, 2 buying points right here, back down to support at 42.74, or on a close back above the 8-day moving average and or the 20-day moving average. That is where functioning as resistance right now. Another stock, AOS, just kind of came on the radar yesterday. Again, basing here, you've got a very clear indication of where support is. It's down here in this between 61 and 60. So see what kind of constructive work it does here. And like I said, it is not in a buy position. Anyway, it's not in a buy position, but kind of like it's in no man's land right now. But it's got 2 places of interest. It's got basically down here at the between 61.50 50 and 60 and up here at 70-ish. That's where it is. It becomes interesting. Somebody asked if I could do a live stock checkup. Yes, I can. Anil, do you have a stock that you would like to have analyzed? Now, for the recording portion of this, folks, you may not see because of the bandwidth issues. Because of the bandwidth issues, it may kind of freak out on us, but that's okay. And you may get kind of blotchy or spotty pictures. Hopefully it won't do that. And why isn't this coming up? There we go. Oh, come on. There we go. Okay, just looking at it, composite rating on Cisco 64. I'm looking at a couple of things here. One, I want to know what kind of industry group this is, whether I want to spend any time on this. Come on, there we go. Industry group, bottom half. So basically, I have two failing marks on Cisco that would tell me it would never make it to my primary watch list. 64 composite. So that's 1, 2 strikes. Fourth strikes. The third strike is that Cisco Systems is the 8th stock in this industry group. There are 7 other stocks that are better than it and stronger than it. Let's take a look here at ANET. That's one of the stocks we have been watching for a while. ANET, let's take a look at that. But that's basically, so this is the third stock on the list. And even its composite rating, 74. You know, I want to see something 80, 85, 90 on the composite level. I want what is strong. Shooting a lot of bandwidth through because I have my live quotes going on also. So there's the chart. It is in correction, and then you look down here at the RS rating, red, green, EPS rating. That's good. Group strength, not kind of less than middle of the road. SMR rating A. Accumulation distribution on negative D, which means it's been in the selling mode. And so it's ranked 3rd, and you can go on down here. Hold on a second. I want to show the rest of what's there, and then we'll call it a day. Or maybe I just go there. Okay, 3rd in the group. Now we're functioning, composite. And what's really cool, if you've never utilized this on the IBD website, you can go here. If you highlight what goes into composite rating, just highlight that, and it'll take you away and tell you exactly what is in that specific area. So again, poor industry group, weak industry group. When earnings are due, EPS, a lot of red there. Some green, price green, RS rating red, and so that's what I'm looking at. And also I'm looking at the annual ROE and the pre-tax margin is actually pretty good. but the debt to equity is also pretty good. And so those look not too bad. Projected growth, but right now, I think what is driving this down is the issue with the accumulation distribution. And what is in there? Composite rating, and it gives you the definition of what the composite rating is. And so that's like I said, I trust or I utilize IBD for my fundamental analysis. And if something passes the fundamental analysis there, then it at least passes one of the tests to get on my watch list. So, and Eric, I'll let you go to the IBD website and find that question out, the top 5 industry groups, because it talks about it directly on there. So, okay, with that, guys, we're going to call it a day. Thank you very much. Have a great long weekend. And also thank you for the kind words from so many folks because of our loss.